Let's take a look at the concept of accruals. Now, there are a couple of methods for taking care of your accounting. In cash accounting, you recognize the revenue when it's received and the expense when it's paid. So you don't recognize a sale being made until you're actually paid. You don't recognize an expense being incurred until you actually pay for it. However, most businesses use an accrual accounting system, and that requires that revenue be recorded when it's earned and that expenses be recorded when they're incurred. And because the movement of cash may not coincide with when the revenue and expenses are recognized, we're going to need to make some adjustments on the financial statement. So if you're doing financial statement analysis, okay, you'll need to look at these financial statements, and you're going to be interested in whether a company has a lot of prepaid expenses or unearned revenues, and that can be important. So let's take a look at a little table here. All right, we have three considerations here. Let's look at the first column. This is the case where the cash movement occurs prior to the accounting recognition. So this is the case, for example, where we have an unearned or a deferred revenue. So someone gets paid, they get the cash ahead of time, but we haven't actually recognized we haven't recognized the revenues. We've received the revenues, but we can't actually recognize them. They're not earned yet. So what happens here? We're going to record a cash receipt, and we're going to establish a liability, such as unearned revenue. And this is quite common. We'll take a look at an example in a second. But this is common, for example, in insurance. In insurance, you pay ahead of time, and what happens? The insurance company hasn't earned that premium. Okay, I might pay $500 for a homeowner's insurance policy, and that's going to be good for a year, but they haven't earned that money yet. So they have to set aside an account that says unearned premium. And as we move through time, perhaps every month, they will recognize some of that revenue and they'll reduce this liability. Okay? If the cash movement's in the same period as the accounting recognition, then there's no adjustment that needs to be made because everything happened in the same period. We paid for it and we recognized it in the same period or received the money in the same period. So there are no adjustments that need to be made. Okay? The last case over here is where the cash movement occurs after the accounting recognition. So, for example, you might have unbilled revenue. Okay, so your originating entry is you record revenue and establish an asset such as unbilled revenue or perhaps accounts receivable. When billing occurs, you reduce the unbilled revenue and increase the accounts receivable. Okay? If it's the case where you have accounts receivable, when the cash is collected, you eliminate or reduce the receivable. Okay? You can also have this case where you have the cash movement prior to accounting recognition for expenses. So you may have a prepaid expense. You may pay for something ahead of time, and so you have a credit coming to you. So if you happen to be the company that bought a liability insurance policy from an insurance company, you've prepaid that expense, and you're going to consider that an asset, and then you're going to reduce that over time as you move through time, and that's actually used up. Okay, every month you've used up some of that insurance premium. Okay, you can also have the cash movement after accounting recognition for expenses as well. So in this case, we establish a liability such as accrued expenses, and then we record an expense. Okay, we reduce the liability as the cash is paid. So let's take a look at a couple of examples. It'll be a lot clearer if we look at those. Okay, an example for unearned or deferred revenue. So suppose ABC Company received $1,200 for a 12-month subscription to a monthly newsletter. The company has an obligation to deliver these 12 newsletters. So they've got a prepaid or unearned revenue, okay, or deferred revenue, and each month as one of the newsletters is delivered, this obligation is going to decrease by 1/12 or $100. And at the same time, $100 of revenue will be earned. So they're not going to recognize that they've earned anything yet when they first create the subscription. They're going to set up this unearned revenue account, and then as they deliver each newsletter, they will recognize that proportionate share of the unearned revenue. You could have unbilled or deferred revenue. So for example, suppose ABC Company ships to a customer 5 books at $25 per book. Invoice terms are that payment is due in 30 days, and in this case no cash changes hand. So the revenue is going to be recognized prior to the cash receipt. What's going to happen here? An accounts receivable is going to be created for the $125, and the accounts receivable will be reduced and the cash increased once the payment is made. Prepaid expenses. Suppose ABC Company pays $3,000 to a landlord for office space. $2,000 represents a refundable deposit. $1,000 represents the first month's rent. So you have 2 prepaid expenses here on your balance sheet. Okay, one for the rent and one for the deposit. Okay, here the cash is going to be reduced by $3,000 because you actually paid out the $3,000, but on the asset side of the balance sheet, it's going to be the same. You're just going to change your assets from cash, that'll be reduced by $3,000, to 2 prepaid expenses. Finally, let's take a look at accrued expenses. ABC Company hires a part-time clerk through an agency that handles all the payroll taxes. The company is to pay $15 per hour to the agency. The clerk works 6 hours prior to January 31st, but no cash will be paid until February. Well, the originating entry to record would be some sort of wage expense or a liability for wages payable. Okay? Once the agency is paid, the adjusting entry is going to reduce the liability, the wages payable, okay, but it's also going to reduce the cash because you're going to be sending them money. So you can see that when you're dealing with accrual accounting, and again, if you're doing financial statement analysis, all the big companies, nearly all companies, use accrual accounting system. A small mom and pop grocery store or something, well, probably not even a grocery store, perhaps a small-time consultant might do something on a cash basis, okay, or somebody selling something at the local flea market. But basically all companies are dealing with accrual accounting, so you have to consider these adjustments that need to be made if you're doing financial statement analysis.